All right, everybody. This is David, aka Reverse Long, with the Friendly Bear Podcast, and today I have the pleasure of introducing a legend in the trading industry, author Jack Schwager. And Mr. Schwager is a recognized industry expert in futures and hedge funds, and the author of a number of widely acclaimed financial books. Mr. Schwager is one of the founders of FundSeeder, FundSeeder.com, a platform designed to find undiscovered trading talent worldwide and connect unknown successful traders with sources of investment capital. Previously, Mr. Schwager was a partner in the Fortune Group from 2001 to 2010, a London-based hedge fund advisory firm. His prior experience also includes 22 years as director of futures research for some of Wall Street's leading firms. Jack has written the books Market Wizards, The New Market Wizards, Hedge Fund Market Wizards, and now finally, recently, if I'm not mistaken, the Unknown Market Wizards came out during the whole coronavirus. And here we go, Jack. How you doing?
Okay, good. Yeah, it came out it came out November 2020. So and I finished it. I sent the manuscript in probably around April or May. So the beginning of the major virus lockdowns, and then it was published, right in the middle of it.
Yeah, I remember I was in Los Angeles at the time, and I had nothing to do because everything was locked down. And you came out with this book and gave me something to do, and I would go hiking and listen to it on audio when it came out on audio. I'll go hiking. What's that?
Go to Red Rocks? You said you were in Las Vegas.
Los Angeles.
Oh, Los Angeles. I'm sorry.
Yeah, I went to like Runyon Canyon and those things. I don't know if you're familiar, but
no, not as much there. Yeah.
Yeah, so it would be great. I'll listen to the book and go on a hike, so it was great. And I re-listened to the book recently before the podcast, and like it mentions, I almost forgot that it was written or like it came out during COVID. It's been so long already. It's been like a year and a half or something. It's crazy. So yeah, Jack, let's start back with before the Unknown Market Wizard, just building up to it. So what got you started in the markets?
Oh, just chance, really. I was out of college. I was out of graduate school for an economics degree, looking for a job, and the first real job offer I got that was, reasonable or meaningful happened to be for a research analyst in commodities. So that's what got me into I had no particular interest in markets at that time. I was really looking for something analytical, something that wasn't like routine, doing the same thing over and over. So it sounded like an interesting job, and that's how I got involved in markets.
Great. Okay, so now going into the Market Wizards books compared to like the Unknown Market Wizards books, what do you think? Because now there's a lot of retail traders. What do you think the advantages are of these smaller retail traders versus the larger traders, which were like the original Market Wizards?
Well, actually, there were always a lot of retail traders. And most retail traders, I should point out, are not successful. So I don't want to paint any misleading implications here. But the one of the main advantages that the retail trader has is just the fact that they're small, and that makes it easy for them to take positions. Particularly, you mentioned before that you trade small caps, and particularly that area where if you really have any size, your entry and exit there's a lot of slippage involved because of the bid-ask spread, and it becomes impractical to do. So if you're a small trader, you actually have an advantage in a lot of these markets, except the very, very liquid ones where anybody can really, move, except the super giant firms, which can move any market.
Now, the retail trader now, so there's a lot of like myself, for example, like a professional retail trader, that someone that's put in a few years of work and self-taught and like learned from courses and information out there that are not just any retail trader. They're equipped with, like I'm in Puerto Rico, equipped with a crazy amount of technology and are surrounded by professional traders from all types of experience and backgrounds. What do you think is like the difference now, the pro retail trader now as opposed to back then? Because back then, there were a lot of barriers to entry. The commissions were high. You would have to call your broker through the phone. Now,
Yeah,
like, you can execute something on the phone, or you know what I mean? So
yeah.
yeah,
Oh no,
what do you think?
all that is absolutely true. When I first started in the business, well, like you say, commissions were very high, and I was in futures, so I think commissions might have been like $50 to $100 a round term, whereas now, for active traders, they could, less than five, it could be a few bucks. Dramatically lower. And of course, on stocks, you also had way higher commissions, and now, well, we don't get into the tangent of free commissions and the fact that it's not exactly free, but still, commissions are like way, 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 way less, eat up a lot less. That's obviously a difference. You have electronic trading exclusive almost, whereas back then, uh, my electronic trading was really the exception. It was very minimal, in fact, almost non-existent. And uh, and of course, the big difference is computerization, right? So this is the traders I interviewed in the first market was his book. Although by the time I interviewed them, we had PCs, but during the most of their trading career it was pre-PC. I remember somebody like Ed Thorp, who was like one of the very early, maybe pioneers of trend following trading, and he talked about he tried to get a job on Wall Street so he can use their mainframe to run his programs. But I mean, he was running basically just simple trend following programs. And he's running them on an IBM 360, which I have some familiarity because my senior year in college, I was taking like a econometrics course and was running programs on that type of computer. So this was like a computer that took up a small sized room and had I didn't have the power of the most basic PC nowadays. So completely different, and so there were no PCs. So as far as the retail trader goes, none of these tools were available. Also, data is a big thing. You had now also you have intraday data. If you're a technical, you've got intraday data down to any time level you want, any increment you want. You got all sorts of indicators. Not that I use indicators, but if you want them, they're there. You got all sorts of programs. You got all sorts of software. So there's lots of technology. Where back then you basically had just last, high, low, and last, and it wasn't computerized. So tremendous differences really in the environment and the cost and the ability of what one can do. Another data I was talking about, price data, of course, fundamental data. Now you've got reams of all sorts of data which were not available at all. So if you're into fundamentals, you can get all sorts of fundamental data and software to manipulate that data, where back then you didn't have any of that. So huge difference. But on the other hand, big traders have not stood still either. They've gone from maybe they were using like mainframes or whatever back then. Now it's supercomputers, and now it's instead of a couple of people, it might be a firm with 100 PhDs in math and physics, and so it's the advantages of, and big data has become a thing. Data which requires supercomputer power to maybe manipulate and analyze. So it's happened on both ends of the spectrum, all the way from the small retail trader to the large trader. So the whole universe of trading has kind of shifted dramatically into the availability of what you can do, and strategies that were non-existent and impossible back in the time of the first market wizards book are now strategies that are used. I mean, so you just didn't have the computer power to even if you take a simple strategy like long short statistical arbitrage, you couldn't do that because you didn't have the computer power to do it, even if you knew the math to do it. So where nowadays that's just like kind of very basic. People can do way more complex things. So big changes.
Yeah, wow. Okay, so and also, all right, next question. What are your thoughts of systematic traders versus discretionary traders? I know in the
Well,
market wizards, yeah, the major ones there were discretionary from what I gathered.
You're right. The main ones were discretionary. You know what? If you think about it, the latest book, which I know you've read, well, actually listened to twice, Unknown Market Wizards, they're actually all discretionary except for one. One is purely systematic. All the others are discretionary. And I think if you go through any of my books, you'll find a heavy preponderance of discretionary versus systematic. And there's a reason for that, and that is, with the exception of a few firms, such as, like a Renaissance, or one of the people I interviewed, Ed Thorp, when he was running hedge funds who were systematic, but not systematic in the way people think of it. It's really more mathematical, more like I would kind of distinguish between what a quant fund and systematic, even though a quant fund is systematic. But when people think of systematic, they're not thinking of that. They're thinking of, using a computer to generate buy and sell signals. Of course, quant funds do that, but they do it in a completely different way, and they're executing thousands of trades and looking for small amounts of edges, and it's a very different type of world. But the exception of some really major quant firms that have done very well, it's very hard to find systematic traders, not systematic traders that are winning traders, but systematic traders who have spectacular performance. And when I'm doing these market wizards books, that's what I'm looking for. I'm looking for, dramatic performance. So, for example, like one of the fellows in this book, could take one of the more extreme examples, Jeff Newman, started with an account of less than $5,000. And I interviewed him, about 14, 15 years after he started. And he had built it up to 50 million, from 5,000. I mean, that's pretty,
Wow.
you don't do
Yeah.
that. Very, very few people can do that with systematic trading. So it turns out, of course, very few people can do it with discretionary trading, but it does turn out that the traders who have spectacular performance, either in terms of taking a small amount of money, building it into a small fortune, or having extraordinary return to risk, with the exception of some of the super quant funds, tend to be discretionary traders, not systematic.
Wow. Great. Okay. And also, so what are your thoughts on technical analysis versus fundamental analysis?
Okay, so I have my own personal biases, but I've interviewed enough people. So I've included in the very first Market Wizards book, and I've not changed my mind after doing 5 of them, is that for some people, fundamental analysis works extremely well, and they're skeptical of technical analysis, and that's fine, because for them that works. And there's some people who think fundamental analysis is a total waste of time, and for them, use technical analysis. For them, that works. So basically, I think it's really a matter of what's right for you. Sort of like, not everybody has the same hobbies. I mean, some people may like golf, some people may like mountain climbing, right? It doesn't mean that one's better than the other, although each proponent will think that. But for each person, whatever their passion or whatever they like best or whatever feels right to them, that's what's best. And it's the same in trading. It's not a absolute of what's best. It's really a personal choice. Now, having said that, I told you I do have personal biases, and the reason I'm biased towards, I did start out as 100% fundamental. I eventually transitioned to 100% technical. The reason I'm biased towards technical is that it's much easier, it's much more compatible with risk management. Fundamentals are very difficult to combine with risk management, which is so critical, which is so important. And if you want me to go out that tangent, I can, but that's one of the main reasons I gravitate to technical analysis.
Gotcha. Okay. And the next question is, so the longer I trade and the more I read your books, because I've read them multiple times, and each time I get something new, it's like something new clicks with me. And the more I get into, like, Ed Thorp comes around, it just becomes more fascinating each time I learn more about him. And recently I realized, the last time when I was going over your books, I realized, wow, so actually I went to UCLA, and he actually lived in the co-op where I used to live. Yeah. And he studied math. I did my graduate degree in architecture, and I studied under Frank Gehry, and he actually designed the mathematics building where Ed Thorp was. So this is all fascinating. I was like, whoa, it's coming full circle. But I wanted to ask you, like now since I have the opportunity, like what was your experience in a nutshell, like interviewing Ed Thorp?
Yeah, Ed Thorp was one of my favorite interviews. I actually spent 2 days there. So I interviewed him for the better part of one day and then went back the next day. Um, Thorpe is a absolutely fascinating individual. He's brilliant for one thing. So just for context, so your audience knows. I mean, Thorpe was he grew up in the Depression, grew up in a poor area of California with a bad school system. He basically taught himself physics in high school. Got accepted to at the age of 16 to some, I forget which of the California university system schools got a scholarship. Ended up going for a PhD in physics, was writing his thesis, decided he didn't know enough mathematics to finish his thesis, so he started taking graduate math courses. Eventually got a graduate degree in math, never went back to finish his thesis. So he, technically speaking, he never got the PhD in physics, but so that's just for educational background. He then went on to do a number of spectacular things. He was like the first person to kind of figure out how to beat casinos. Now people say, well, you can't beat the casinos. Well, you can't in the conventional sense. You can't, but he started out with roulette, and I know my initial reaction if somebody said they can devise a way to beat roulette. I say, well, that's ridiculous. It's impossible. It goes against probability. That's true if you're just going to do it with a betting scheme, and that's kind of a blind alley, but and a fool's alley, I would add. But Thorpe's approach was different. He decided to do it by using Newtonian physics to figure out probability-wise which was the octet of the roulette wheel that was most likely for the ball to land in and get a higher probability on bets. And to do that, he had to build along with and I'm just getting a tip of my tongue now, but known as the father of information theory, was an MIT scientist. Anyway, the two of them kind of were the first to build. This is back in the 60s. This is like 2 decades before the PC. They built a miniature computer that could be worn on a shoe, and where they could transmit signal. They could transmit signals to where one would be timing, when the ball passed the roulette marker, and then again when it did. So it could calculate the velocity and calculate, what was the most probable portion of the roulette wheel would land. So they did that, and then Thorpe figured out how to beat blackjack, and he wrote a book. And the trick there, not the trick, but the insight there, and it's a brilliant insight, was that even though blackjack still has an edge it's the smallest edge, by the way, if you're going to bet in a casino, which you shouldn't because it's a loser's game, but if you're going to bet, your smallest odds of losing are blackjack. The odds aren't 50-50, but they're, I don't know, I think the house has about a 1 to 2% edge if you play perfectly without counting cards. Of course, now you can't count cards thanks to Ed Thorp. But bottom line is he figured out that even though you had a game which had a losing edge, if you bet more when the probabilities were in your favor, then you can turn the odds in your favor. So if you bet more when there were lots of picture non-picture cards out, non-aces, you could win, and then you would bet very small amount when there were a lot of pictures out. And by using that, he was able to beat the casinos. He wrote a book called Beat the Dealer. I have a thing in that interview with him about how there were discussions about what to do with Thorpe, whether they should knock off the mathematician, and they decided against it,
Yeah.
But it's also, and he had an attempt on his life, which is described in the book, by his car being fixed. Sounds really like out of a movie when you read this thing. And anyway, so he did that, and then he decided, well, there's got to be an easier way to make money. And he figured he might as well go to the markets, and he kind of tried technical, getting into technical, reading stuff on technical analysis, decided that wouldn't work, but then figured out there were abnormalities or aberrations or inefficiencies. Inefficiencies is really what I'm looking for in the markets that he could exploit. And so he was the first one to come up with statistical arbitrage. He was the first one to come up with convertible arbitrage. He figured out the basic mathematical equivalent of the Black-Scholes model several years before the famous paper was published, which won the writers a Nobel Prize. But he didn't publish it because he was making too much money using it. So this guy just has one thing after another, just extraordinary. And the reason I say it's one of my favorite interviews is because of all of those accomplishments, of all his brilliance, he wasn't like an egocentric person. He really was just a good guy, a nice guy, and he wasn't condescending. He wasn't. He was just like somebody we'd be friends with. So I liked him as a person as well, besides just admiring him for everything he'd done.
Wow, absolutely fascinating. Okay, and what gave you the idea to write The Unknown Market Wizards?
The original one or the unknown? Oh, the unknown.
The unknown, yeah.
The unknown. Well, the book I had done previously was called Hedge Fund Market Wizards. So you think about it, Hedge Fund Market Wizards is all about guys managing lots of money. And I think what's the exact opposite of that would be, writing about guys just trading out of their home office and nobody knows exist and doing spectacularly well. So it was the exact opposite thematically, although they both deal with trading. So they're actually similar in that sense. And the lessons have overlap for sure. But the type of people I was interviewing were different. And also, you mentioned FundSeeder, where because by doing FundSeeder, in fact, some of the traders were found through FundSeeder, and that's basically a website where traders can go and link their accounts. And for us, it's a way of finding undiscovered trading talent. And traders get all sorts of free analytics, on the platform. So, that's the carrot for them. And also, if they want to manage money, there's a possibility that they get selected for actually in the process of trying to put together a fund. So there's a possibility of getting access to capital that way too. But in any case, through that, that was the catalyst for the idea, beyond it being the opposite of hedge fund market, was just simply dealing with a startup which was focused on these type of traders. And so that's where the concept of that book came from.
Great. And how long does it take you to interview a trader in The Unknown Market Wizards versus the original Market Wizards?
The time varies widely from the first book to the last. And it's not when I was interviewing them, it really depends on the individual and the story and whatever. And in some case like Thorp, where he had a long career with lots of events and willing to talk about it, I might have spent 10 hours plus. I spent a lot of hours interviewing him because there was a lot of material. Also, a number of other books, Jeff Newman. Spent a lot of time with Jeff Newman, wrote a lot of stories. And Peter Brandt, again, an interview over 2 days. I think another one that number of hours were in the teens. And to appreciate that, when you're talking about hours in the teens for a single interview, that gets edited way down. So like to when you're listening when you're listening to the final interview on the tape, it's going to be less than an hour probably in most cases, and that includes my writing, not just the interview itself. So the written book is really taking the essence out of each interview, but you need to conduct these long interviews sometimes to be able to pull out the core material.
Yeah, okay, so I was gonna ask you, like, how long did it take you to get in the zone, to get a trader comfortable with you, to give you their information? Because I know a couple of them, it was I think one on the Unknown Market Wizards, I'm not sure.
Yeah.
He was on he didn't want to give it at first, and then you kind of wrote it anyway, and gave him another pass.
So that was
and
Jason.
finally,
That was Jason Shapiro, and he was coming. I live in Boulder, and he was coming to Boulder for a wedding, and he had read my books. They were very influential for him. It actually comes in the interview. I only put that in, and almost every trader will mention my books, but I only put it in if it's really, really pertinent to the interview. But it was for him. It was kind of pivotal. In any case, So he was coming to, he knew I lived in Boulder and sort of wanted to meet. And, we're just chatting on the phone. He's telling me all about it. And I said, hey, it sounds like a pretty interesting background. I said, you might, I'm planning to probably do another book. Would you be interested? Would you be interested? Or I am doing it at that point. Maybe I'd already decided that I was working on a book. And he didn't. No, I said I've always kept a low profile. I don't want to do it, whatever. So he came, and we talked for a couple of hours in my office, and he had a lot of great stories and whatever. And sort of that was that. And he specifically asked me not to tape. So about 6 months later, I was working on a book. I was getting not towards the end, but not. And I wrote him an email. I said, I've got this book, and you'd be a perfect fit. Your stories are great. You want to reconsider? And it went back and forth, and then then I got a thing, and I told him that basically, whatever, I forgot what I told him essentially, but he knew that he would be able to review it, and he knew from reading my books that they're, that I kind of not trying to exploit anybody or anything. So, but he said, I thought it over, and I appreciate it, but I just decided I'd rather just stay anonymous. And 2 minutes later, I get an email saying, "Screw it, let's do it." So or
Yeah.
something to that effect. And so I re-interviewed him. This time was in the height of the pandemic, and this time I just interviewed him. Originally, I was going to fly out to the East Coast to interview him, but this time we just did it over over Zoom. So, but I already had met him, so it was less important for me to meet him again in person. And went over basically the same territory, but for the interview.
Wow, that's so cool. All right, and how did you hear about each unknown market wizards?
Basically, there were several ways. First, I knew some of the traders. For example, Peter Brand is a friend, and I had intended to include him the next time I did not because he's a friend, because I thought he had tremendously important things to say about trading. And there were I think there was I'm trying to think who else I knew. A couple of people that I kind of I think knew or knew of. Then there were people that I found through FundSeeder, and then there was I have a Twitter following, not huge, but 50,000 plus or whatever. But at that time, maybe it was a bit less. But in any case, I put out a tweet saying, "Look, I'm doing a new book. If you are a market wizard, if you have spectacular trading performance for preferably a decade or more, or somebody who fits that bill and are potentially interested in being interviewed for a new market wizards book, let me know." I got probably over 500 responses, and I kind of filtered that down to a few people that I used for the book.
Uh-huh. And did you find some through FundSeeder?
Yeah, I did. There were several
Yeah,
traders down in FundSeeder. Yeah.
I got you. Yeah, the reason I'm asking, so I signed up for FundSeeder, I think when you mentioned it in the book, or I don't know, in an older
Yeah.
podcast somewhere. And I was looking at it today. So do I need to not make withdrawals for it to look better? Because I think when I was making withdrawals, it looks like I took losses, but it's actually withdrawals.
No, it shouldn't turn out that way. And this is because unfortunately, brokers have different systems and everything else. But basically, that's a mistake. When that happens, and it's picked up normally, but if there's a big spike down or spike up that's due to withdrawal, that should adjust from the brokerage itself, because it may sometimes it doesn't show up in the same day and it shows up on the next day, but it should show up. If it doesn't, that's due to some sort of like I say, there's lots of different brokerage. Every broker has a different way of doing it. So it could be a broker-specific problem. I don't know. Who's your broker?
Interactive Brokers.
No, so Interactive Brokers is good. No, Interactive Brokers should work properly. But occasionally
I think
things
I'm reading it
happen.
wrong. Yeah, I think I'm
Yeah.
reading it wrong. I need to
So,
practice a bit.
and Interactive Brokers, I should say, changed their system, and that caused some issues. So basically, that's something that has to go. We have to have somebody go in and manually fix it. And we basically tell people, if you've had that happen, just just go in, just send a note to help and what the issue is, and so
Gotcha.
so yeah, that can happen. So it shouldn't show up. It shouldn't show up as a loss
I
or
got
gain withdrawal, or those things should not have any impact.
Gotcha. And you're one of the co-founders of FundSeeder.
Yeah,
Yeah. So FundSeeder is like, it's a crowdsourcing thing, so like so people can
yeah.
find traders to invest.
Not so people can find them, so we can find them. So the model is not to connect individual investors with individual traders. Uh, the model is basically to connect, well, either to form a fund, which is the first step, and use some of these traders, and eventually, or alternatively, work with some uh, wealth management groups or whatever, your family offices, more larger financial entities. So I guess it could be an enormously wealthy individual, but to work with larger investors to form portfolios. So that's the model. The platform for the traders, the analytical platform, was the focus initially. It's only now that we're beginning to start to focus on the investment side using the database of traders.
Gotcha. And going back to the trading topic, so what do you think separates the pro traders or exceptional traders makeup from the average profitable trader? You mentioned in the analogy of a marathon runner in the Chat with Traders podcast from a while ago,
Yeah.
and mentioned that people can run marathons with training, but only a few have the innate ability to run at a world-class level. What do you think comprises this with being a top level trader?
Yeah, well, I kind of believe that. I think it's true of anything. Everybody, not everybody, but a lot of people have some specific talent. Uh, that talent could be anything. It could be in sports, it could be in music, it could be in writing, it could be in some sort of creative process, it could be in starting companies, uh, it could be in sales, it could be in a lot of different things, okay? But not everybody is born with any special innate talent to be a great trader. Now, you can become, like in anything else, I mean, you can not have the talent to be a great musician, but you can still learn to play an instrument, right? So you may not have what it takes to be a great trader, but you could still turn yourself from a losing trader to a winning trader by enough effort and going to the right sources of information, right? So it's the same thing. Let's say you're a runner and you want to run a marathon. Well, if you're not in shape, but the point is, running a marathon is a hard thing to do. It's impossible to do without training. So, if somebody hasn't trained, they start to try to run even a mile, they're going to have a hard time. But eventually, if they really keep at it, almost anybody can run a marathon. And the pace is another story, but they can do it. But I don't care how much work, how much effort you put into it. Only a small percentage of people will be able to run, a tiny percentage of people will be able to run world-class marathon times, whether when men or women, different times there. So, and the analogy is the same to traders. I don't think everybody could be a market wizard. I think most people can transition from being losing traders to maybe net profitable, but to become a market wizard, it does require some sort of innate talent. That talent could be, as in the case of Thorp, it could be a mathematical talent and creativity as well, I would add. It could be, as a case of somebody like Jeff Newman or Michael Marcus, it could be a real intuitive, just a brilliant intuitive sense of where the market's, what the trend is, where people are going, and I think some people just have that. It's not something that you can learn so much. Maybe you can, I don't know. But I think it's more a matter of just it's a natural ability. So that's what I was talking about in that analogy, is that to answer the question, can everybody be a market wizard? The answer is no. Can most people improve as traders by doing all the things I tell them, all the advice I give in these books? Yeah, I think yes. I think you can improve dramatically if you follow the advice in the books.
Wow, that was fascinating. All right, so you mentioned persistence as a quality of the market wizards. Can you describe the level of persistence some of them had so that the listeners can have an idea of what it
Yeah.
takes?
Well, there's probably no better example that the first chapter in the first Marco Wiz's book, Michael Marcus, who I just mentioned briefly. Marcus, and Marcus was reluctant to do the interview. He's somebody nobody would know exists except for people who worked at Commodities Corp, which was a prop trading firm that was famous in the 80s. Um, and Marcus would have been completely unknown other than that small coterie of people. He's inherently a very shy person. He doesn't give interviews. He doesn't talk to a lot of people. And he didn't, even though I knew by the way, my first job in Wall Street, which when you asked me how I got into markets, I basically took the job that Marcus was leaving to become a trader, which is how I met him, which is how I knew him. And he was in New York for a few years afterwards, and we had periodic lunches together. We became friends, and then he moved off to California, where he became a big trader and stuff. But so when I did the Market Wizards book, this is like maybe 15 plus years after I first met him. By that point, he had like been super successful, and he didn't want to do the interview, and it took a lot of convincing. And actually, a mutual friend finally talked him to do it. But so he did it. But once he decided to do it, he really opened up, and he started going through his whole career from the very beginning. And it's a fascinating story because he just blew up again and again and again. And I won't go through the whole itinerary, the whole story here. It's in the book, but it is just incredible. And at one point, and the blowups were really painful. And at one point, I asked him, I said, didn't you ever kind of think that maybe you just were not cut out to be a trader? I mean, why did you keep on going back after failure after failure? And he just said, I just kind of felt that I could do it. He used this analogy of like the protagonist in Fiddler on the Roof, looking, not literally talking to God, but like he almost like saying, just feeling that he had this sense, and maybe even a religious sense, that he just could do it. And he went on. Eventually, he got it right, and he went to trade prop money at Commodities Corp. They gave him a $30,000 account, and a dozen years later, he had turned it into 80 million. So it was quite a story. But now the point there is, he had a lot of talents, he had a lot of vice, there's a lot of things he did, but the one point is that he kept at it despite failure after failure after failure. That doesn't mean everybody who fails repeatedly is going to succeed, but it does mean that a lot of people who are super successful have gone through complete failures early on, but they had some sort of inner drive and persistence that kept them going.
Wow, excellent point. And now, how do you think the market wizards, including the unknown market wizards, went about finding a way to trade what fits their personality?
Oh, well, that's an item of discovery. So a lot of traders, whatever they start out with is not necessarily what they stay with. And sometimes what they start out with works, but then stops working. So they change either because the markets change in the sense of that particular approach, or because they change. But and not everybody starts out knowing what type of trading is right for them. They try things, and this doesn't feel right, that doesn't feel right, and eventually they find something that feels right to them. So it's a matter of basically self-discovery. You don't. There's no way. If anybody tells you what the right way to trade is for you, don't listen to them, because they don't know what they're talking about. They don't, unless they happen to know you immensely well, better than you know yourself. What they're telling you is nonsense. You just have to discover it. And how do you discover it? Well, read a lot of books, see what feels right. Experiment using different approaches. Even paper trading, preferably in the beginning, because why risk real money until you have a method? And try to get a sense of what feels right. don't expect it to take less than 2 to 5 years, because that's what it takes. It doesn't mean magically at the end of 5 years you will discover the perfect methodology for yourself. Some people may never find it, but realistically, you should expect to spend a minimum of 2 years before you have an inkling of what your approach is.
Oh, wow. Great. Okay, so now moving on to the unknown market wizards. Okay, so Peter Brand talks about how chart patterns were easier to read in the 70s and how HFTs have changed the game around chart breakout points. Could you
Yeah,
elaborate on this?
yeah. So basically, and I think that's true in a lot of different things. The fact that you have this massive computerization that has occurred. I talked about Ed Secoda running the first trend following systems off an IBM mainframe, where now anybody with the most basic PC can run trend following. And when I say now, I mean actually for decades now, anybody with the most basic PC can buy some trend following program without knowing any programming, without knowing any math, without having any particular knowledge, and just kind of run a trend following system, right? So, or they could just, they're subscribing to just a broker might have just these, basic tools like moving averages that you can kind of do a moving average cross and get a trend following system. So you don't even have to do any system. You can just kind of look when the moving averages cross. So that's got to change things. So when you go from a place where almost nobody is doing it to where hundreds of thousands or millions of people are doing it, it's going to change the behavior of the market. And the same thing goes for chart analysis. Chart analysis used to be this kind of backwater that nobody paid attention to, and it was some just odd ducks in the corner who were doing it. And I mean, it's funny. Peter Brand called this is a great example. Peter Brand called he wrote a blog letter, still writes it, called the Factor. And I asked him, well, what where did the name come from? And basically told me that because back then when he was like he had clients, he was working as a broker, and he went through this certain early phase where he tried fundamentals, wasn't working, and then he kind of discovered chart analysis and it started working for him and all that. And then he would like have these like signals like soybeans, or they could have this major move and stuff like that. But his clients were, without them mentioning, they were like these major firms, like major food firms or whatever that were doing hedging and stuff like that. He couldn't tell them, soybeans are going, buy your soybean meal because there's a breakout of the head and shoulder pattern and stuff like that. So he would have to come up with he would go to some fundamental guys and tell me, hey, is there some reason why soybeans might go up? And they give him some fundamental reasons, and he would make that the reason. So when he got around to naming his letter many years later, and people called it, they call it the Brand, not the Factor, it was like the BS Factor, so, but that's where the name, so he was almost using the fundamentals as a story without, but really he was doing his analysis with the charts.
Wow.
So we came from an environment where if you were a chartist, you almost had to disguise what you're doing to have anybody listen to you, to a point where charts have become kind of very popular, technical analysis become very popular, and millions and millions of traders use it. So that changes things. So you get classical chart patterns, you get many chart patterns that might have worked with some reliability in the past. The frequency of reliability has just deteriorated because too many people are following the same pattern. And when that happens, there'll be lots of false pattern breakouts out of those patterns. In fact, the false breakout themselves end up, and I wrote this in a book, in one of my non-market wizards book called The Complete Guide to the Futures, which was originally, actually was my first book before the Market Wizards book. And a revised edition came out in 2017. But I have a whole chapter in there, like the most important rule in technical analysis. And it's basically that failed signals are actually more reliable than actual signals. So when Brandt is talking about this, he's basically saying that, well, he used to have 20, 30 things that he could look at, but now it's come down to only a few patterns that are truly reliable. And so the markets have changed in that respect. There are some still reliable patterns, but they're much fewer than they used to be.
Wow. Awesome. Okay, and Peter Brand also mentions that he hates indecision and regret, and that's why he's a discretionary trader. You think that's one of the key traits of being discretionary trader?
Is what hating
Indecision and regret.
on regret? Well, I can speak to my own experience where I went from fundamentals to charts and then decided I didn't like trading because of the emotionality and this thought, well, I get rid of the emotionality, go into systematic. And I did that for a number of years. But I ultimately decided I didn't like and then I was basically a trend following systematic. And I didn't like it, didn't feel comfortable because you just have to wait. If you're a systematic trader, you got to wait for the signal to change. So if you have a market move that you have a large market move in your favor, the signal to reverse or get out could be a good ways away. And I just didn't feel comfortable just sitting around waiting for, even though you would follow the system and be risk management in that sense, you didn't have control of that. So I went back to just chart analysis because at least then I could say, I could set the stop. I knew roughly what the risk would be. And then if the market went in my favor, I could raise it and I could keep the risk to a certain point. And I just felt more comfortable. And I think that probably that's what Brand is talking about, is just has full control that he can set the stop to a point where it's going to be very small. And one of the, maybe the most important, and Brand will tell you this, yeah, he's a chart trader, but I bet you he would tell you that before he's a chart trader, he's a risk manager. So the most important thing about each trade is he knows how much he's risking, and it's a fraction of 1%. And yeah, it's at a point where the charts are telling him the odds are better than normal for a move in one direction or the other. But it's also a point where he can define a meaningful risk point that allows him to trade for a fraction of 1%.
Wow. Excellent. All right. And which unknown market wizard started with the most amount of money, and then and then also which unknown market wizard started with the least amount?
Gee, on the of all the people I interviewed ever,
And the unknown market
on the
wizards.
unknown. Let me just look through, and the least amount. I think Jeff Newman has to take the prize there because he started
Or
with
the 5,000.
He started at less than 5, so I don't think anybody can compete on that. Let me see if any of these started with a larger amount or large. Nobody started with a large amount. Well, yeah, Parker did, I guess. Let me see, would he be the largest one? Probably. Marson Parker, he came into trading through, being a software engineer and software, and he was with some IPO, and he got bought out, and so he had some money. So I think he might have started out with an original trading account that was $1 million or something like that, which he eventually pulled money out of, lived off of. But I think he started out with over $1 million stake, if I remember correctly. But whatever he started out with, it would have been more than the other traders in the book who all started with pretty small sums of money for the most part.
Gotcha. Now with Newman, did he grow exponentially, like consistently the whole time, or were there spurts over a period of years?
I plotted Newman's NAV, and I had to use a log graph because it kind of becomes it doesn't look correct on a arithmetic graph because for those listeners who are not mathematically oriented, all you have to know is if you plot something in a log graph, equal percent moves will look equal size. So if you make 50% on 5,000, it will look the same as 50% on 5 million, or 50% on 50 million. It will be the same amount on the chart. Whereas if you don't do that, what happens in somebody case like Newman, who goes from 5,000 to 50 million, you basically have the chart look very flattish for a long period, and then just rise asymptotically upwards, sort of like COVID in Louisiana right now, or Florida. Just goes straight up, and that's what the chart looks like. And that's not because suddenly yeah, he's making a lot more dollars, but that's because if he makes 10% on 50 million, that's 5 million, right? And back when it's like even 50,000, you know, if he made 10%, it would be 5. There would be nothing. Wouldn't show up. So that's why somebody like Newman, you have to plot on a log graph. So if you do that, you get a graph that looks like this. It's like uptrends that look sort of, like these spurts upward, like maybe diagonally upward, 45 degrees. Then it goes into a sideways pattern for a couple of years. Then another big upspurt and sideways and upward. But each of those upward spurts are huge increases of dollars.
Wow. Okay, and what is the most common trait of all the unknown market wizards?
Well, I would say the most common trait of all of them, and probably of all the market wizards as a group, is a strong risk management profile. I mean, there are very few exceptions. No exceptions in unknown market wizards. There's at least one exception I can think of in the whole series of market wizard books, but for the most part, almost all of these people have extremely strong respect for money management, and that's like the dominant trait of successful trading. Is that? I mean, there's lots of other traits, but if I had to say what is the single most important, both most common and most important trait among highly successful traders, it would be risk management.
Excellent. Okay, and then so Richard Barr talks about getting out of a trade quickly if it goes against him because he doesn't want to be trading from an emotional and egotistical standpoint by remaining in the trade to prove his bias. He talks about cutting it immediately in this scenario and reassessing it for re-entry. Can you elaborate on why that helps him?
Yeah, sure. Well, for context here, Barge is somebody. Well, he's evolved to do two types of trades, but his original type of trade, and maybe still his most important type of trade, is picking points in the market when there's some sort of fundamental event, say central bank announcement or something like that, and trading that announcement in a way when he has high confidence. And but it could also be like a situation where there's some background fundamentals and that's coupled with some sort of chart breakout. It could be any type of thing, but the common denominator is it's a point in time where he has high confidence of the market moving in a given direction at that particular point. So if it's like a central bank announcement, because the announcement has just come out, if it's some sort of chart, if there's some sort of underlying fundamentals and there's a chart breakout triggering, as a trigger, it's because this thing should make the market move, and now you have the move beginning. So there's some reason why, if the trade is right, it should just go right from there, right? So what is kind of his profile trade is to take a very large position. It would seem almost recklessly large position at that particular juncture. But he's able to do that only because he thinks there's a strong chance of it going one way immediately. And if it starts to go the other way, he'll get out. He has to do that because if he's not absolutely disciplined in getting out quickly, if it doesn't go the way he expects and responds to the event, then he could take a really big loss. So his very survival depends on his ability to absolutely always cut his losses immediately if the initial response he's expecting isn't what he expected.
Great. Wow. Okay. Okay. So, can you go over the SpongeTech trade that Jeffrey Newman did, as well as the market making strategy applied with entries and exits?
Yeah, sure. So that's one of the stories in the Unknown Market Wizard, which is one of the kind of more colorful stories. And Jeff looks for, well, he has a lot of different, I won't go into all the different things he does. But for this particular trade, and one of the things, he started out trading penny stocks. He still trades a lot of small caps because, or sub $10 stocks, and I guess even occasionally penny stocks. Although given his size now, he's so much larger. And since I did the interview, he's in the hundreds of millions now. So these type of trades, I assume, are now, no longer, as feasible or meaningful. But back then, very, very beginning, he started penny stocks. Now, penny stocks for most people is just a sucker's game. They'll lose money. They're the patsy, in the pump and dump scheme. No, Newman never had any inside information. He was never part of that, but he made money because he was able to read the situation correctly. So there was this stock called SpongeTech, which I guess at the time, I don't know if it was a penny stock or maybe it was $1, maybe $1.02. And he noticed there wasn't a big float. I don't know, maybe 1.5 million shares. I forget what it was. Not 100 million. I forget whatever the float was. The number's not important. But he noticed that insiders bought like 50 or 75% of the shares, and that's the only reason he bought it. He just saw this massive insider buying. So he went long, and the thing started going up. Now, SpongeTech, one of the things he always does is he gets to product. And so what SpongeTech was, it almost sounds like a joke. SpongeTech was a sponge which had soap inside, and so you would shower and you would use a sponge and it had soap come out. And he kind of bought the product and he used it and he kind of liked it. And anyway, he had this insider buying. That was the real reason he did the trade. And initially it was a very cheap stock and it started going up. Now, SpongeTech started doing all sorts of sports advertising, so you would see a tennis match and you'd see, the SpongeTech banner, or you'd see, some football game. And, they started doing a lot of like high profile sports advertisement. And so people, all these sports fans would say, I guess it was maybe the GameStop of its day. And so a lot of people, so Jeff recalls like he's, in a bar with friends who don't know anything about stocks. They're talking about SpongeTech, and, is it a buy and all of that? Of course, he's long this whole way. And it goes from $10 to $15 and 20, it's going up. And Jeff has this thing that he always, from the very beginning, he's taking full summers off for vacation. He does a lot of traveling. He's been to God knows how many, scores and scores and scores of countries, a lot of, but he takes the summer off and does this little adventure. And in this particular case, he was going away for the summer. And he was still using a BlackBerry. We didn't have the iPhone and, and all that. And he went on safari in Africa, and he's somewhere in a remote place in Africa. There's no phone connections. There's no computer connections. And one of his friends had sort of taken his advice, he got in the stock. So he gets I was a BlackBerry user only for a short time, so I'm not familiar, but I understand that BlackBerry users, even when there's no connection, where you don't have any, connection like for a regular iPhone, BlackBerry users were able to connect to other BlackBerry users. And I'm not familiar enough exactly how that worked, but they were able to do it. So he gets a message, he's in the middle of Africa here. He gets a message from his friend, SpongeTech is like $25. What do you think? And he's desperate to sort of, get some sort of connection. So he goes, I guess he's in a tent and there's some sort of office, and they have like some sort of like dial-up PC, like AOL or whatever, I don't know what. And it's one of those things where you have to wait for minutes and minutes to get a connection. He talks them into letting him use it. And sort of after like the laborious thing, he gets in, he sells this. He had been selling along the way up, but he still had about half his shares, and he sells everything. And he goes back to his tent. And by the way, SpongeTech went up to about 28, 29, I think was the high. And later, like minutes later, maybe it was like 10, 15 minutes later, he gets another message from his friend. SpongeTech is down to $5. What should I do?
Wow.
So he was like, the pump and dump was over.
Yeah.
I guess, and it turned out these scammers, they also scammed the advertisers and the sports teams. And, I think I forget what was the stadium as well, but they never paid for a lot of their advertising either. So they're complete scammers all around. Now Newman didn't know any of this. He just basically bought the stock when it was $1 because he saw the insider buy. And then he had this, like I told you, he had great intuitive sense. When he saw when he saw this like 25, he knew that he didn't know where the top was going to be, but he knew he wanted to be completely out. And so he ended up basically getting out on the high, virtually near the highest
So
that ever made.
so he got a text on his BlackBerry in Africa, in the middle of Africa, and that's
Yeah.
when he probably felt like the ultimate euphoria if he was able to get that message through his BlackBerry in the middle of the desert about SpongeTech.
Well,
That might
he
have been
didn't
a
have euphoria.
signal.
No, I think it was more a matter of anxiety because he didn't have a way to put his order in. So it was just, I think it was, he probably would was more anxious until he
Yeah,
finally put the order through. So that was his response. That was his initial response. He's like, you have to get this order in, and how's he going to do that? So
yeah,
he managed to do it.
fascinating, fascinating. That's a great story. I love that chapter. Okay, so all right, one of the market wizards, Michael Keane, talks about shorting biotechs because he viewed as an underperforming sector. He mentions that an under 300 million market cap biotech has never had a cancer drug pass a phase 3 trial. Do you
Yeah.
know if he would track all his data or how much data he used in combination with deciphering the news to see if it is a spin job, for example?
If it's a what job?
A spin job.
Oh, yeah, yeah, he does that. He'll look for, for spin jobs. I mean, that's, and not only in biotechs. I mean, biotech is his specialty. Uh, and that's one of the main things he does look for, but he'll also look for it in other companies too, to some extent. So his other shorts will be that type of thing where it's a spin job and there's some news that comes out that's perhaps not as meaningful as they're spinning it to be, and the market rallies a lot on it, and that's the spot where he'll go short. So yeah, that's that. He does look for that, and he likes the short side of biotechs. Not he also goes long biotechs, but it's a matter of time window. He'll go long biotechs before they when they're far away from an announcement of any sort, of a test being finished, and where he's anticipating that brokers are going to start to kind of push the stock because, hey, there's this thing coming up. So he's trying to get in early on that. And he'll be out well before he expects the results to come out. So he's also on the long side. But the short side will come in where he's expecting the odds to be that this is not going to be anything. And everybody who's in the stock was just going to get, they're just going to take the big hit when the news comes out. So he picks his spots. And one of the things he said is, like, as you noted, was there's never, a lot of times you get some of these small biotechs will have a cancer drug and it'll go past their first trial or whatever, stage 1. And just he uses the odds. I mean, of all the ones that have ever gone before, there's never been one that's been sub 300 million that's actually had gone through the process with a successful cancer drug. And he explains that one of the reasons is that they really had something, probably someone big would have acquired them,
Wow.
before that point. So he considers it unlikely, and he's just going with the odds.
Great. All right, so you mentioned Pavel Craigchi started out as a bellhop and slowly transitioned to full-time
That's a
trading.
check name.
Yeah, oh, check. Yeah, he would take out profits monthly out of his 50 to 80K account. I think. Do you think 50 to 80K would be all he needed to trade with the style? Like, did he ever size up, or why doesn't he size up
Well,
more?
he'd love to size up, but you're talking about a guy whose career, never went further than high school in the Czech Republic, and didn't even do well in school. Had a teacher, he took one economics course. What he remembers his teacher telling him, Pavel, you will never succeed in economics or something like that, some discouraging message. And went into the military, got out, and became a bellhop for a decade. So this is a guy with really almost no money other than what he scraped together. And so he lost his initial stake. Then he tried to then he did lots of research, came back again about 6, 7 months later, and finally figured out a way to win at the markets, and has been doing that now for 15 years. But he never had a lot of money, and he's in the Czech Republic, so his expenses aren't huge. He lives in a small village, a couple of thousand people. And so basically, he's one of these things, if you look at his NAV, it's sort of kind of steadily up. Almost not every quarter is a winner, but I don't know, 90% of quarters are winners. And so he's making money fairly consistently. but he never has a lot of money. So he has an account somewhere 50 to 80. If he doubles, if he has a 50, he has 50 and he doubles it 100, he's using the 50 to live on. So he's never getting ahead anywhere. He's just living off his profits. And it's just a consequence of the fact that he's never had the opportunity. And in fact, he's kind of a classic example of somebody we found on FundSeeder, because he would have like zero chance of ever raising any money, no matter how good. And his return risk is excellent. And by the way, he's even though he's trading a small amount of money, from almost the very beginning, he changed his methodology to only trade mega cap stocks, because he felt that if he ever was successful, he didn't want to have to change his methodology. So he could literally be trading. He could be trading not only 50 million, he could be trading a billion on this, because the stocks he's trading are the largest volume stocks. He could be trading, I think you could trade maybe multi-billion on it. I don't know. It's not a matter, his trading style could probably accomplish very large amounts of money. It's just that he doesn't have it. But somebody like him could never get anybody to back him, because, he's always trading a small account. He has no educational pedigree. All he has is a super consistent track record trading highly liquid stocks. But that's what we would look for.
Wow. Yeah, I'm sure he is an inspiration to a lot of people out there in other countries, starting with a super small amount of money. He started out as a bellhop. It's incredible.
Yeah,
Um,
and I love the story. What inspired him? He said he kept on seeing these wealthy tourists in this hotel and he just in Prague. Yeah, his hotel was in Prague. So he worked at some hotel in Prague, and he kept on seeing these wealthy individuals in the lobby reading the Wall Street Journal. And he said, "Gee, wouldn't that be a great life just to be there? Like investing in."
yeah.
So that was his
Wow.
inspiration while he was working as a bellhop.
Wow. Now he's a market wizard now. All right. Do you plan on making an Unknown Market Wizards 2 book or any other future books in the
Yeah,
works?
I'm not planning it. One of the traders, actually Chris Camillo, um, who trades on social media. Anyway, he had, I've been in touch with him multiple. Actually, he's one of the traders I knew, because I had met him. He came out to meet me in Boulder on a totally unrelated reason, but when he told me a story, I knew about him, so that's why, he didn't come to talk to me about his, being a book or anything like that. It was a completely different matter. But I knew about him, and so that's. But he, when I had interviewed him, he had turned his 80,000 into, I guess it was maybe 10 million, or I forget what it was. But 10, 12, I don't remember. But anyway, I spoke to him during COVID, or after COVID, not after, but when it was going a while, and he suggested, be a great idea to an update which includes this period, because it's such a wild market. So this was after the big march down, and then the super rebound after that.
Uh-huh.
And sort of he did extremely well during the whole thing, and he thought there were some interesting stories there. And I said, well, it's a good idea. I just don't know if I want to do the work, but so he gave me that idea. And I've thought about it. I'm not sure if I'll do it or not. And I know a lot of the traders have done extremely well. I know Newman is just completely knocked out of the park during this whole period. So I know there's some real good stories there post period of the end of the interview. So I am kind of thinking about, well, maybe I'll do one or two of these post interviews and see where I'm at. Maybe I'll do it. Maybe I'll do a second edition that includes those that period. So it's
Wow.
possible.
Great. Good to hear. Okay, okay, so your book came out during COVID, and it's crazy because a lot of beginner traders came into the market during the past year, more than a year, past year and a half. Some of them are probably listening to the podcast. So like, why should new traders buy this book?
Well, they should buy this book to keep them from, if they made money, they should buy this book so they don't give it all back, and what they started with.
Yeah, yeah.
And yeah. Well, it's hard to imagine anybody just came into the market during this past year and is trading off of Reddit that's going to be, I mean, I wouldn't say it's impossible to be successful long term, but I would say the percentage of those traders that could be successful long term is going to be small. And they think they found something, but it's a flash in the pan. It's just something works. Something works now. Well, one thing has changed. This whole thing has changed. Like the GameStop changed the game, as pardon the pun, because it's the first time that I guess I can think of where social media was used to get a whole bunch of independent, tens of thousands, maybe hundreds of thousands of independent traders. I wouldn't say to collude, but to cooperate, you know, in a trade. And so while they're all like small traders, or almost all small traders, in mass, they could have an effect. And so especially on the short side where the upside is unlimited, and you mentioned that you do a lot of focus on short selling. So you more than anyone can appreciate it, is the biggest difficulty, particularly in stocks on the short side, is that the upside is unlimited. You could go, and the best example, I could use the recent example, but one that has historically completed the whole cycle, I can't think of a better example than 1999, early 2000, for a lot of these internet names, where anything that had the internet to do, even if they had nothing to do with the internet, or even if they were consistently losing money, or even, no matter how broken the idea was, they would just be soaring. So you could be a stock that's trading at $10 that is losing money every month, that has a burn rate that's going to take them out of business in a year and a half. And the stock is going to zero. But if you have a lot of people just buying everything that's internet because, even if they're completely, not even, but because they don't know anything, and it starts pushing the stock up, well, it's overpriced at 10, it's more overpriced at 20, it's more overpriced at 40, it's more overpriced at, it can go to 200. So short sellers can't survive a situation like that. Eventually, a lot of these stocks went to zero. So yeah, they were right, but it's a very difficult situation. So if you're a short seller and you want to survive, you always have to have an out point. And so if you get a situation like GameStop, which is, and I don't do fundamentals on stocks, but from what I understood, maybe GameStop was a stock at the time which might have been had a fundamental value of that maybe $10, $20 were things I saw or heard. And it goes in a week or two time, it goes as high as in the overnight market, I think even 500. I mean, that's just insane. It's not real. But if you're a short seller, and there are a lot of these short sellers who were trapped, that basically wipes out their fund. So you have this different element that never existed, where you had things where everything was known and it would happen much more slowly. Like in the internet stocks, it would be going up every day, but it wouldn't be like overnight something like this, or over a week you have a stock quintuple when there's nothing to it. So it changed the game in that sense, but it's certainly not something that I could see will be a strategy, survivable strategy. Ultimately, traders that don't know anything can't win. I mean, it's just they may be lucky initially to ride it, and a lot of these traders who did trade on that, they didn't get in GameStop at 20 or 30 or 40. They got in at 300, even 400 or 200, whatever. So, and then they sort of go all the way back down to 60. So I think that if they think they know how to trade off of that, they're kind of deluding themselves, and there's a lot more to it, and they're only seeing a very small spectrum of markets. It's like the old cliche about three blind men and an elephant. Depends which part of the elephant you're touching to think of what it looks like. Well, they're only touching a small portion of the market. They have no idea what the big picture looks like and what other market phases look like, and therefore that's why I say, well, they need to educate themselves beyond just this social media trading.
Absolutely. I agree with you on that. Now, what are your thoughts like on the crypto, like going into the same scenario there, but with crypto?
So crypto is tricky. stuff like Dogecoin or stuff like that, I, if I could put a 50-50, bet one way, or the other, will it go up or will it will it be worthless or worthless? If you go long-term out, I'd say most of these Me Too coins will be exactly what they should be worth, which is zero. So I think it's only a matter of time before a lot of those cryptocurrencies go to zero. And I don't understand NFTs at all. I can't see them surviving, long term as value, for those people to come out ahead. So I think to me, it's like a tulip mania type thing for a lot
Yeah,
of us.
exactly.
Yeah. Now some of the more realistic cryptocurrencies like Bitcoin or Ethereum, a few of them, there it's trickier, like particularly like Bitcoin. Now, the thing that my initial inclination is, this is going to be a bubble of some sort, and I still don't shake it entirely. But I always had, and the reason I said that was because it has no purpose in being. Something can't be a currency if it's swinging wildly up and down. I mean, these firms that are taking, it's more of a marketing thing, but to take crypto in exchange for products is ridiculous because the value changes in a time you're putting in the order, the value can change dramatically. So it doesn't work as a currency because it has no stability. Now, there's one place where it does work as a currency, and that is in black market activities, whether it's for buying, for dealing in drugs or in ransomware and stuff like that. That's where it has an application. So so it has a real application. Now the real applications, I don't mean Tesla taking Bitcoin, which is like a gimmick, but I mean real applications. The real applications are nefarious ones, but it doesn't make them any less meaningful in an economic incentive way, right? You have an incentive for people to use it. And something like take Bitcoin, the ultimate supply is limited. So there is a scarcity issue. So there are arguments why it could work. So I'm kind of undecided there. I guess if it was just a 50-50 bet long term, I would still be inclined to bet against it, particularly if governments started making it, if governments found a way to make it impossible to use for stuff like ransomware and black market activities, I'd feel more comfortable saying that it's going to fall apart. But because of that, I don't know. But these other currencies, I think they're sucker plays.
Wow, excellent. Well, thank you so much for all that insight. We're gonna wrap this up now. So thank you, Jack, for taking time out of your schedule, being so generous with me and coming on the podcast. Really, really appreciate it. It's an honor to have you on. Like it's truly an honor. My whole journey is studying it's a very overwhelming in the beginning days, and like I remembered the Market Wizards book was just so inspiring, as well it is for any trader that's went along the path. The Market Wizards is like the foundation, and then like to have other books to follow up just to continue, and the Unknown Market Wizards, even it's just great material to always revisit every now and then. I really, really appreciate that. I'm grateful to have you here, man. This has been an honor.
Yeah, I appreciate that. Thank you.
Thank you, Jack. Well, that concludes today's episode. I'm gonna have all of Jack's stuff in the notes. Make sure to get the Unknown Market Wizards book. It's absolutely it's awesome. Great read. The audio is A1. Everybody's got to get it. Well, thank you so much, Jack. And that concludes today's episode on the Friendly Bear podcast. I'll catch you later, Jack. Thank you.
Hey, take care. Bye.
Bye.